Hi, my name is Josh Mahony, Chief Market Analyst at Scope Markets. This week brings the crucial US Core PCE Price Index inflation report on Friday that really tails up a week that will see plenty of volatility anyway, most notably because we've got the Bank of Canada expected to cut interest rates, but also we've got a number of significant corporate earnings being reported over the course of the week, with a couple of the Mag 7 names in the form of Alphabet and Tesla both reporting alongside Visa. I've provided a preview for that. But nonetheless, what we want to get into here is the core PCE price index. And with markets expecting to see the first rate cut, it's been long awaited, from the Federal Reserve in September, this is really going down to whether it really reiterates that confidence or whether we see people rowing back on those expectations. And in actual fact, one of the key takeaways from what I'm going to show you is that the disinflationary pathway that we have seen for the core PCE that has made it the favored metric from the Fed in terms of justifying a rate cut, we might actually see that shift where we see the CPI number showing significant disinflation, but the PCE metric actually starting to stutter a little bit. And that really comes down to shelter and the way that it's calculated. So let's get into it. First and foremost, I want to show you the overview. This is the likes of the CPI, core CPI, and core PCE. You can see the purple line at the bottom highlights just why, and I've been highlighting this for some time now, just why that core PCE metric is the main reason why we might see the Federal Reserve cut interest rates. 2.57 is the latest reading. You can see here core CPI 3.3, CPI 3%. Neither of them are going to get back to target nor get anywhere near target by the time we see the Federal Reserve step up to the plate in September. But it's that headline sort of Fed's favored inflation metric of the core PCE figure that really does give potential justification for that. Remember, they've said that they just want to see a pathway back down to target. They don't want to cut once they've passed that 2% threshold because that might be too late. Of course, it takes a while for these interest rates cuts to feed into the economy. Here's what we're expecting. I've also added the metric from Thursday. This confuses a lot of people. That core PCE prices quarter on quarter. This is the advanced figure this time around. So a lot of people think that is the core PCE reading that we should be holding out for. What's notable about it this time around is, as you can see here, it's an advanced metric, right? And so what we're seeing is a quarterly figure. So that other one is a quarterly figure released on Thursday. So it wraps up the whole of Q2. So number one, the quarterly will give you a good idea of what's happened before on a sort of bigger picture. And that's why I've highlighted it to you in the past, saying that, it highlighted the significant bout of inflation we saw in Q1, and it sort of wrapped it up in a nice package. But every few months you see it in this format, and this is where it becomes interesting, right? Because we're seeing the Q2 figure before we see the June figure, and of course June is part of Q2. So that reading on Thursday could give us a slight inkling on the direction of travel for Friday's reading. So we could see some volatility on Thursday as well around that core PCE prices quarter on quarter figure. But then realistically, the big report is going to come on Friday, where the main figure we're going to be looking out for is that core PCE price index 1.1 expected. We don't necessarily have the year on year here. Let me just see if I can get it up. Core PCE. Here we go. So in terms of expectations for the year on year, according to Trading Economics, we've got it at 2.5%. For some reason, they didn't have it on the calendar. So a decline from 2.6 to 2.5 and a flat figure of 0.1. Now, you might remember that I highlighted that we might see something different this time around to what markets are expecting. And part of that is highlighted here. So this is the nowcast, inflation nowcast, provided by the Cleveland Fed. And essentially, the Cleveland Fed will take in a number of different factors that are utilized to calculate the core PCE figure, and they will give you an up-to-date reading on where they think it's going to come in, right? And as you see here, 0.2 is the expectation from the Cleveland Fed. So that highlights a disparity from what markets are expecting, which is 0.1, and what is expected here, which is 0.2. And of course, if you take 0.2 and you times it by 12, of course, because it'd be 1 month, then you're looking at an inflation rate that would be tracking around about 2.4. That would still potentially justify a downside move in terms of that year-on-year figure, but it would be a lot more borderline compared to, of course, what markets are expecting, which is that 0.1 figure. So if it comes in at 0.2, there's a possibility we might see that monthly metric higher than expected and the annual figure fail to budge. Now, what are they expecting here? 2.47 on the core reading. So that's 2.5, which is in line with the decline expected on trading economics. But certainly this would point towards the potential for an upward surprise to this report. Now, those of you casting your mind back to the recent CPI reading, everyone's felt great ever since. That was part of the reason why everyone's so confident of this rate cut in September, because we saw a lower than expected reading in terms of both monthly headline CPI and core CPI, in part driven by shelter. And so we can see here in terms of that light blue line that we've got at the top, that shelter has been over and above where the rest of inflation is, by and large. And part of that is down to the calculation. And it's a really slow moving metric here. Essentially, it doesn't only factor in the most recently agreed rents, it also factors in previous rents, and therefore it can be very lagging, a very slow figure to turn around, the shelter component of the CPI metric. But it makes up roughly a third of the CPI. So it is the kind of thing that is going to hold up CPI and make it actually not necessarily as accurate as could be, because, of course, we're seeing shelter moving in a different way from perhaps live rents that we're seeing within the markets. Now, what's interesting is that we have different calculations for the PCE metrics and for the CPI metrics. And that's part of why we see core PCE significantly below the likes of core inflation. And you can see that here, 2.57 for core PCE, 3.27 for CPI. Now, this is from a month ago, but this was provided by the Bureau of Labor Statistics and shows you the disparity, the sort of deviation between CPI shelter, which is, of course, CPI metric, and market rent. And you can see here that we have got this significant gap between the two. We've got that CPI shelter moving significantly lower, as I've highlighted in that previous chart. But we're starting to see that market rent metric actually start to rise on a year-on-year basis. So we've already seen that big decline. It sort of bottomed out at levels that were sort of the levels that we saw pre-pandemic anyway. And now it's starting to rise a bit. So you would, looking at this, say, well, actually, the disinflation played in by the decline in terms of market rent has probably already factored into the core PCE metric. And so we're looking for the rest of the economy, in particular the services sector, to see that disinflation feeding through to get back down to 2%. Whereas on the CPI shelter metric, which is that dark line, the non-dashed line, you can see that it's continuing to decline. So that slow disinflation we're seeing feeding through that has held up, because it's elevated, it's held up that CPI metric. It does point towards the continued driving of downward pressure for CPI, but we're not necessarily seeing that for the core PCE. So whilst we've seen the core PCE moving towards the downside ahead of the CPI numbers, and that's given us greater confidence that we are going to see a move back down towards target for their favored metric, the dynamics of the differential between these different ways of measuring shelter or rent means that we're likely to see continued disinflation, all else remaining equal in terms of CPI, that we're not necessarily going to see in terms of PCE. And that's why it looks likely we're going to potentially see a higher monthly PCE figure, core PCE, than we would the core CPI. Here's the usual chart that I provide for you guys. You can see here the comparison between CPI 3.3 and PCE 2.57. You can see on the middle section that the figure that is going to be stripped out this time around for the PCE is 0.172. And so that highlights the idea that if we did see a figure that was over and above that 0.1 metric, i.e. the Cleveland Fed pointing towards a possible 0.2, then there's a good chance that we see that year-on-year figure essentially remaining flat as 0.17 has dropped out and something similar is added. We don't necessarily see significant change. Do we see markets suddenly start thinking, oh, is this last stretch from 2.6 down to 2%? It may not be as easy as we might think. Well, let's look ahead, and we can see July and August are both below the figure that's being stripped out this time around. September's where we're probably going to get a decent bit of disinflation, and then towards the back end of the year, not that much either. So if we see a flat year-on-year core PCE metric this time around, there's a good chance that we're essentially going to see something similar for the next 2 months. And then maybe in September, so it's probably going to be released in October, we might see some decent disinflation, maybe getting down more towards your 2.3s kind of area by that point. And then more of the same in terms of potentially struggling just above that 2% mark. And then you look at the beginning of next year, and then suddenly you have the threat of real significant disinflation. You're looking at that January figure, which is around about 0.5 for the month alone. You're looking at March, which is 0.4, 0.3 for February. So those three alone, plus April, you're talking about the vast majority of that core PCE inflation metric being stripped out over the course of 4 months. So they've got an interesting position, and I guess that they do have the ability to look certainly towards the back end of the year and say, look, okay, even if we're tracking at 2.3, 2.4%, we know that we're going to be below that 2% mark when we get out of Q1 of 2024. And so they are able to look ahead to that. We have seen this chunky inflation at the beginning of this year. It's starting to come under control. And, maybe we don't necessarily see, if we see that disinflation pathway stop and we see core PCE inflation just flatlining, maybe it doesn't give that big boost to markets. But at the same time, I don't necessarily think that it completely wipes off the idea of we're going to see a September rate cut and we could see another one towards the back end of the year, because towards the back end of the year, they're going to probably start worrying that inflation is going to be closer to 1% than it is to 2%. So it really comes down to sentiment around this release. I think if we do see that disinflation continue, everyone's going to feel great about themselves. We're probably going to see increased pricing towards the back end of the year in terms of how likely it is that we see multiple cuts this year rather than the September meeting, because at the moment markets appear to think that that's pretty much nailed on. And then we'll see people sort of shifting expectations for next year as we see that big chunky disinflation period at the beginning of next year coming into fruition. But certainly, like I said, in terms of that shelter component, that could be the thing that sort of throws off the party this time around, so to speak, if we did see that monthly figure coming at 0.2, and if that potentially puts the year-on-year number flat. So in terms of expectations, this is according to the CME's Fed Watch. And you can see here that the shift over the course of the past month has just been more heavily towards that rate cut in September. Now markets think it's pretty much non-existent, the chance that they keep rates flat. That is heavy in that direction, quite frankly. I think it is likely that they cut, but of course, if we see a higher inflation figure in terms of core PCE, maybe we see a little bit of a pushback, but nothing that's suddenly going to make it the base case scenario or anything like that. The base case scenario remains a rate cut in September. That's probably not going to shift all too much. But if you're looking at a direction for it to shift in, most likely it would shift back away from a rate cut just because of the sheer degree of expectation attached to that rate cut and the possibility that we see a higher figure for that core PCE metric, as I highlighted. We can see here that the expectation for this year is a little bit more interesting. So as we can see here, the single rate cut into 5 to 5.25 is what we're looking for. But markets feeling very confident that we won't be there by the end of the year. Instead, they're largely split between 2 rate cuts and 3 rate cuts this year. So that's probably where you see the sort of shift in terms of pricing, in terms of expectations. Do we think we're going to get loads of rate cuts this year, 3 rate cuts? bearing in mind we don't have that many meetings left. Or are we just going to see the 2 rate cuts and a more moderate stance from the Federal Reserve? That's likely going to be where the big shift takes place, and that's likely going to have the knock-on impact in terms of market sentiment for trading around that. Let me just take you through a few charts. First and foremost, I wanted to bring up the Dow Jones Industrial Average. It fared pretty well recently, given that sort of rebalancing away from the Mag 7. We've seen this pullback over the past couple of days, and it does point towards a possibility of a wider retracement. We don't necessarily know how deep this retracement is going to go, but in my mind, it is likely to be a retracement. I don't see this as a top or anything. So it looks to me like a retracement before the bulls come back into play. So we'll look at this from a sort of fib stance and see exactly where this could come into. As things stand, we've come into roughly that 50% support level. You can see just above that level, which is at 401.44. If we come into this deeper zone, in particular up towards the trendline support, that looks like an interesting area for the bulls to get back into play once again. But nonetheless, there's different ways of playing it, and we could also look at it on sort of an intraday basis and look at this and say, you know, we've got this nice short-term trend of lower highs and lower lows. If we see a break up through your near-term swing high, we could potentially see that as a bottoming pattern before the bulls come back into play. But you know, you're tallying up a long-term trend here with the shorter or medium-term trend. So this is a daily where we're looking for a pullback and potential basing pattern over the intraday basis. And so we're looking for that on the intraday basis. So multi-time frame analysis, but ultimately this pullback, I think, is likely to be a short-term phenomenon. And the question mark here is, do we see a continued disinflation in terms of the core PCE? Maybe we don't, and then that could just point towards us drifting a little bit lower. But ultimately, markets are tossing up whether we see 2 or 3 rate cuts this year. So there is significant confidence that we will see rate cuts coming into the fore soon enough. And that's likely to make people feel pretty good about themselves and likely see this market coming back into strength once again. So like I said, unless we see a decline through 38909, I think there's a good chance that this current pullback is short-term, is a short-term phenomenon, and that the bulls come back into play. But it's crucial to look for confluence in terms of trendline support, in terms of Fibonacci support, potentially in terms of patterns on the intraday basis, and look for confirmation off the back of that. In terms of the dollar index, this is a really interesting one. I've overlaid the US 10-year with the dollar index. And so what we have been seeing recently is this gradual decline in terms of the US 10-year. That's likely to continue the more people expect to see rate cuts from the Federal Reserve. And as you can see here, a very nice correlation between these two markets, the 10-year and the US dollar. So that points towards the possibility of further downside coming into play if we see the Federal Reserve cut in September. So if we see weak inflation data, if we see potentially weak economic data, it's likely to drive down the 10-year, it's likely to drive down the US dollar. If we see further nods from Fed members about the possibility of interest rate cuts, and a significant number of them this year, again, that gives us greater confidence that we are going to see the US 10-year roll over and the US dollar rolling over. In terms of an intraday basis, we can see here that we've got, let me just hide that for now. We've seen this significant rally recently, and we've rallied up towards this deep area. I mean, it's 104.4 that's been tagged so far. 104.5 is the key level. If we break up through that level, you're looking for a wider rebound to come into play. But until that happens, you can see this latest rebound looks like it could be ready to falter. If we see the bulls coming back into play for equity markets, if we see people feeling more confident about this September rate cut and for 3 rate cuts this year, that could feed into further downside. But if we break through the 104.51, that could be the signal for a wider rebound coming into play for the US dollar. And finally, coming into that theme, I remember talking a bit ago in one of my videos about the possibility of the US dollar weakening against the Japanese yen, because of course we're seeing the two moving in opposite directions, people feeling increasingly confident that we're going to see a rate cut from the Federal Reserve in September and that we're going to see multiple rate cuts this year. And at the same time, we're seeing some inflation pressures build in Japan. We're seeing the likes of the BOJ signaling the potential for an interest rate cut, an interest rate hike. and tapering of their bond purchases. All of this points towards tightening from one central bank, easing from another central bank, possibility of a market top coming into play. But it comes off the back of a really protracted rally here. I mean, the yen has been a brilliant trade. It's been a very clear underperformer. But if we break the 15452, then, that trend appears to be over. We have broken through that ascending trend line. So certainly we've seen some big signals already that we could have seen a top here for the US dollar against the Japanese yen. In the near term, we can see also this nice pattern of lower highs, lower lows. So unless we break up through this recent swing high of 158.8, then this pair looks like it could roll over. And in particular, if we see the core PCE inflation metric coming out low, then again, more stories around potential weakness for the US dollar, which could continue to feed into the weakness we've seen for dollar yen of late.